My name is Deanna, and I work with Tempo Family of Funds and Syndications. And today we're going to talk about what's happening in the market. This is the 2024 real estate outlook for commercial real estate, but we're going to talk about the strategic investment plannings and economic shifts that are happening. And so we're going to talk about a lot of different topics and dive into a lot of details. So I hope you're ready for a long one because there's a lot of people on this panelist discussion. I want to make sure everybody gets a chance to speak and give key insights and any information we think would be helpful for investors. So thank you all for being here. So let's get started. So Chris, you have known us for a long time, and so thank you for coming on. I want you to just introduce yourself and get a little bit about your background and why you were invited to be a panelist, because I know you have some financial advising history in your portfolio as well. So let's.
Yeah, so obviously the topics we're talking about today, this is the kind of stuff that financial advisors are scared for you to learn about. Not because of the economic parts, but because of the strategies that they never recommend, right? Because they're not going to recommend anything besides mutual funds and insurance. And so I'm more of an anti-financial advisor. I'm completely against the grain. I used to be one, and I've since repented and repented of my ways, right? And the last 20 years have been doing real estate investing and things like that. And so I focus more on two basic things. One is we actually consult people on how to create enough passive income to become work optional, right? How do you strategize and make this all work together with your finances? And then two, how do you use a strategy like infinite banking, but what we call is max ROI infinite banking, which is the best designed version of that to go with your investments, not to compete with them, to actually work together to throw more gasoline on your fire to help you achieve that financial freedom faster.
Thank you. Well, that was a really good intro. So let's go on to Jake Vanderslice.
Thanks for having us on today. We're VanWest partners. We're a self-storage owner-operator based out of Denver. We've got 38 self-storage facilities, about 19,000 units, just over 3 million square feet. And generally, we target undermanaged self-storage properties that have below market rents, above market expense loads. Maybe they don't advertise well. And we add value first with capital improvements, but mainly through operational efficiencies by way of our management platform. We self-manage our whole portfolio. And we're excited to see a rate cut, knock on wood, next week, which I'm sure we'll get to.
Yes, I will. Thank you, Jake. Rob, thanks for joining us. Can you tell us a little bit about what your niche is?
Sure. Thank you for having me. Very much appreciate it. Rob Levy, one of the managing partners of LBX Investments. I guess the best way to describe us, we're contrarian real estate investors. We have primarily over the past 7 years focused on the retail space. We just felt it was a kind of misunderstood, misallocated sector in the market, and we thought there was value there. And so we own about 4 million square feet of retail, primarily in the Southeast, Midwest, and a little bit in the Middle Atlantic states. That has been a great play over the past 6-7 years, as the markets were concerned about the death of retail and the Amazon effect, and we felt that was all kind of overstated, and therefore there was value in the market, and so that has been great. But we do have pretty diverse backgrounds in real estate. So over the past year, we have been investing in multifamily because we felt it was overpriced, way overpriced in 2020, 21, 22, and into 23. But certainly that has, in our view, changed, and so there's some value in the multifamily market today. So we have been investing in multifamily as well, taking advantage of some misvalue there.
Thank you. Paul, thanks for joining us. I wanted to have you on last time, but you weren't able to join us, unfortunately. And so happy to have you this time. You got to unmute yourself, but I want you to introduce yourself next.
Yeah, great to meet you, see you again, see everybody else. I am co-founder of Wellings Capital. We're a fund of funds. I had a podcast for years. Mike Zlotnik was on it. Several of you guys were on it probably, called How to Lose Money. And I made a lot of mistakes in my earlier life. And so trying to make up for those now that I'm 60. I know I don't look 60. You're probably thinking I look 70, right? But anyway, good to see you all. And our fund invests in self-storage, mobile home parks, RV parks, multifamily, open air shopping centers with Rob, and light industrial. We're also doing a lot of pref equity and JV common equity now.
Thank you. We did have Dave Van Horn from PPR invited, but unfortunately he couldn't join us today due to a death in the family. So I wanted to announce that. Unfortunately, he will not be joining us, but we are grateful to have the whole crew here, basically, otherwise that everybody who was invited. So Frances is not in real estate particularly, but she is a special guest on, she's been on our podcast as well. And we're having her join us for a lunch and learn in October. So don't miss that one. But Frances, can you tell us a little bit about yourself and what you do and why we invited you to be a part of the panelist discussion?
Sure. I'm a Fed nerd, basically. I'm sure there's some mental illness associated with that has not yet been named. But I trust the pharmaceutical business will come up with something soon for the cure. And an interest rate nerd. And my passion in life is global macro. I've been an advisor at an RIA for the past 6 years. I'm now moving into more of the public space with a UN committee role, where I'm hoping to comment on fiscal restructuring, for countries like El Salvador and some of the Central American countries, but ultimately any country who's interested in that. We saw a big surge in fiscal spending, sort of worldwide, attendant with the pandemic that has some consequences. But basically, originally I predicted the financial crisis. I shorted the S&P and then got into media because people wanted to know, how did I do that when so many experts didn't see that coming? And that kind of just started off my trajectory of studying the business cycles and credit cycles and getting into interest rates, and then managing money thereafter, and now getting into the public policy space. I'm also going to be doing more of the global macroeconomic strategy now for a new RIA called Scarlet Oak Financial Services. And basically, that's it. I'm on Bloomberg and Fox and CNBC quite a bit, talking about all things Fed policy. Thank you.
Yeah, I think there's a special type of person that understands that stuff and is very passionate about it. But we'll get on.
We should allocate most of this panel to Frances, by the way, given what I just heard.
Well, thanks. Thanks for joining us, Frances. And
that's too kind.
Definitely enjoy having her on here, and looking forward to that lunch and learn in October. But moving on to our next guests, Neil Whalgren and Andrew Gee. They're from Mag Capital. Neil, why don't you go ahead and introduce yourself, and then we'll let Andrew go after you.
Yeah, absolutely. Good morning, everyone. Neil Whalgren, partner at Mag Capital Partners. We are really an investment firm focused on net leased industrial. So we work primarily in the light manufacturing space. We own about 10 million square feet, largely around the Midwest. And we have a bit of a niche acquisition strategy where we work primarily with private equity-backed firms and do sale-leaseback acquisitions.
Thank you.
Hey, everyone. Andrew G., partner at Mag Capital, and on the same team with Neil, and glad to be here. As Neil said, we focus primarily in industrial, and here to share about our experience, but also learn from all of y'all. And so glad to be here. Thank you.
Well, thanks for coming on. I want to introduce Mike Zlotnik. I work with Mike. He is also a Fed nerd. But Mike, go ahead and introduce yourself a little bit and tell about your background and what we do.
Thank you, Deanna. Thank you all kindly for coming on this industry panel. I am honored and humbled to have you all. You guys are sort of, let's just call it in my top 10, right? You're brilliant, you're wonderful, you're awesome. So I appreciate you all. Just wanted to say thank you for coming. Yeah, just Big Mike, Tampa Family of Funds and Syndications. We are fund of funds model, as well as some niche lending. And certainly, as Paul mentioned today, we love more preferred equity as debt. This is kind of a very hot topic. We'll chat more about this. That's about it. So just again, and I run the podcast with a cheesy name, Big Mike Fund Podcast. If you're bored, you got nothing else to listen to, that's the podcast. Many of you have been guests, and always awesome to have you on the podcast and try to make it entertaining and educational. And every time I turn on TV, I'm looking for Frances just to just for the record. So yeah, she's just awesome. I don't know. I honestly, I don't know anyone more brilliant who can talk average Joe's language on a Fed funds policy. J. Powell a little bit easier, but during the days of Greenspan with Conundrum, without Francis, you could get very confused to what's really happening. So thank you for having you. Thank you for coming on this event. So thank you.
All right, let's dive into some of the topics. I think the first topic, which is more recent in the news, would be what's the impact on the upcoming election for commercial real estate? And I'm not sure who would want to volunteer first for this. Raise your hand. But before that, I just want to encourage everyone who's watching, go ahead and put your questions in the chat, and so we can answer them maybe as we go, or come back to them at the end. But who and our panelists, would like to go first to speak on if there's any specific policies or regulatory changes that you believe investors should be keeping an eye on as we approach this election? Anyone? I guess, okay, Frances, go ahead.
Sure. So may we live in interesting times. So election, basically, and we can delve into this topic a little bit more as we go on, that one of the reasons that we have, not had a recession in the face of a record rate of tightening, rate of change of rates for, a long period of time, is because of the high fiscal spending. And so when we look at the administrations potentially coming in, we want to look at that fiscal spending, because that fiscal spending has been providing the liquidity that the Fed has been trying to take out of the system via higher interest rates and also the reduction of the balance sheet. And so from that perspective, we can assume, I think, and I haven't heard otherwise, and somebody correct me if I'm wrong, that if Kamala wins, that we are going to have a little bit of the status quo as far as administration and some of the fiscal spending. A lot of fiscal spending has already been approved. That I know that the White House had a strategy to kind of continuously push some of that out into the economy to keep it robust into the election. And if Trump wins, he's got this wonderful anomaly, Elon Musk, who now has this Doge potential appointments. And that's going to be, making the government more efficient and reducing regulations and switching the government operating basis. There's a wonderful podcast that explains all of this called All In with Elon Musk. And I think he had an interview a couple of days ago where he explains the mechanics of this. And he takes the operating system from the public and centralized operating system into more of a private sector and, operating system. So somebody wisely pointed out that government spending accounted for about 40% of the GDP, which has been kind of hanging in there in the face of this tightening. And so if you were to drastically cut fiscal spending, you risk drastically cutting liquidity and you risk drastically cutting GDP. And fortunately, he said that they would be doing this sort of on a gradient and wouldn't be reckless with it. But it's just kind of a fascinating thing. So what I'm most interested in, what I like about Elon, is that he looks at things mechanically. And I don't think that he's easy to manipulate. When he's looking at something mechanically, he sees things that other people don't. And so that's really becomes the question. is what is going to happen with government spending, depending on who comes into office and how the fiscal adjustment adjusts for compensating for the Fed tightening. And that may be some of the reason that the Fed, lowering rates, you may be able to sort of thread that needle. But that's the question for me.
Well, I know that there might be a lot of tax law changes, and we'll probably dive into that on our next Lunch and Learn with Brandon Hall in more detail. But if anybody else wants to chime in on that topic about any regulatory changes or policies that you think would affect your industry, let us know.
I'll just add one quick comment. So again, Francis, brilliant commentary. Of course, Democrats likely going to continue to spend, and Trump is going to go a little bit more fiscally responsible, just general conservative versus progressive sort of thinking. But the other quick comment for real estate, for our industry, for us, right? What we would love to see is extension of 2017 tax laws offering 100% bonus depreciation. It's a little bit selfish for all of us, but that would be a more likely scenario with Trump than with Kamala. It's that simple. So, and everything else, of course, election year spending, again, that Francis talked about this, so I don't have anything else to say.
Yeah, and I just want to clarify, I'm not an advocate necessarily of keeping the fiscal spending irresponsibly high. Our balance sheet in the United States, if you remove the United States as the world's reserve currency, we have the balance sheet of a third world country, and it's not sustainable with $1 trillion a year just paying interest. I think it's superseded now the defense budget. So I'm not necessarily an advocate of that, but when I look at the system mechanically and not politically, if you make an adjustment, you have a concatenation of events and other valves in the system. My husband's a racing engineer, so I think of this like, if he makes an adjustment to the downforce, it changes the suspension on all four wheels. And so you kind of have to look with those unintended consequences. And, I think Elon is going to have the skill set to be able to do that.
Well,
I'll add a comment here as well.
Sorry.
Just to add on to everything there, but when it comes to this, like a lot of people are hyper focusing on the presidential election and who's going to be elected. But the truth is, it really comes down to local level. Who are you going to be voting for in your state, right? Even your House of Representatives and your Senate, they're the lawmakers. They're the ones that really make the ultimate decision. The president gets all the glory or not the glory, depending on what happens. But it really does come down to those local levels. And so rather than trying to follow the media and social media and everything else, where you'll hear all kinds of lies and and even threats about are we going to have unrealized capital gains or not? The truth is, guys, it really comes down to who do you elect in that local scene.
Yes, thank you for that comment, Chris. I totally agree with that. I was going towards Andrew because I'm curious to hear what your thoughts are on the upcoming election and how it's going to shape the economic landscape, specifically for the industrial industry.
Sure. Yeah, first of all, I completely agree with what Francis and everyone else has said. In my mind, though, I kind of felt like both sides, are expansive. I think we're not particularly restrained as when we had, back in the 90s and under other presidents. But hopefully we'll shift back. I'm interested to learn more about Elon and what he's doing there. I think on the industrial side, obviously we've been seeing kind of the reshoring with of manufacturing and production centers. But I think for that to really happen in the in the next decade, there needs to be investment infrastructure, power, grid, and whatnot. And I think a lot of that probably will be coming from government side. So it'd be interesting to see. It's not going to happen tomorrow. It might not even happen in the next 4 years, but it is something that in order for our country to continue to grow in this sector of kind of bringing, factories and manufacturing back to the States, we need that infrastructure.
Definitely. Well, I want to talk about the yield curve and the market implications. So Francis, can you give us a little bit of context on that? And let's dive into what the interest rate changes with the yield curve inversion and uninverting. What does that mean for real estate if we enter a recession? And what are the implications if we avoid recession?
Right. So the yield curve inversion has almost every time in history portended a recession. And it doesn't happen when the curve inverts. It happens when the curve unwinds the inversion and uninverts. And I can explain the mechanics of that. But just quickly, like I said, we've avoided this recession. There are three factors to having avoided this recession in the face of this record rate of tightening thus far. Number one, the fiscal spending, which I agree with Andrew. There's no way we have too high of a level of debt that both sides are sort of mechanically required to continue to be expansive. I think the Democrats will be more expansive than the Republicans when it comes to the fiscal side. And again, we're driving 200 miles an hour into some kind of wall, proverbial wall. And so, until that happens or we have a major credit crisis, we're going to see the status quo. The second reason that we have not seen a recession is because when the yield curve inverts, that disincentivizes banks to lend. We saw when the Silicon Valley Bank failed and we had those, bank problems when they had unrealized losses and liquidity issues on their long-term bonds. Now, why would they have that? Because the bonds they bought at low interest rates are now not competitive in the market against the bonds as rates have risen. Those long-term bonds, as the curve inverts, now banks don't pay 5% to their depositors, but essentially somebody's paying on the short end of the curve at that 5%. And if that 10-year is lower, somebody's picking up that revenue from those long-term bonds on the longer end of the curve. The Fed, guaranteed that they could borrow the bonds, use the bonds as collateral for a new loan at par. What I thought was very interesting about what the Fed did at the time is they didn't give them lowered interest rates to borrow at. They still had to borrow at those very high interest rates. So anyway, the banking system survived. But the point of the yield curve inverting is it disincentivizes banks, commercial and industrial loans to lend. Well, the second reason we didn't go into a recession was the second anomaly, which is when those commercial and industrial loans went down and the banks weren't lending because of this inversion. You had the private credit markets from the excess liquidity from COVID stepping in. So ordinarily what you would have had when those banks stopped lending was you would have had some rate of defaults, right? Some rate of correction. When loans default or are written off, they come out of circulation. So that serves as a further tightening of the system. Well, because you didn't have these defaults, because the private credit markets swooped in, you didn't have a credit situation that would normally cause loans to be written off, which would further tighten the system. So you didn't have tightening from that occur. The third reason that we avoided a recession, and this is kind of one that I saw in hindsight, when you have a record amount of credit card usage, people are bringing on new debt. When you are bringing new debt into the system, you are adding to the money supply. So the 60% of Americans who are living paycheck to paycheck and increasingly using credit cards for things that they wouldn't have ordinarily used cards for, given the fact that since January of 2021, the aggregate costs have gone up approximately 20%, even though we have the rate of inflation, the rate of change on inflation is slowing. You have people putting groceries on credit cards. You have people putting gas on credit cards. Now, if those people were spending their salaries or their savings on groceries and gas, okay, that's not bringing new money into the system, which means that's not bringing new liquidity into the system. But as an anomaly, they're putting these things on cards. That's bringing new money into the system. So you have liquidity pouring into the system from fiscal and a record amount of credit card usage. And then you have canceled the default mechanism through the private lending. So the private credit markets. And so those things have held off the recession. Now, as far as real estate, you have to ask yourself, are we going to have a recession? Okay, so the inverted yield curve has normally, been a sign of a recession. But I will tell you, during the tech bubble burst, and I'm just going to look at my notes here, so from the time period of the curve first inverting to the start of the recession, which is at the start of the steepening. If you go back and look at the Fred chart on the 2s and 10s, and you look at historically when the gray bars are indicating recession, it's when the curve starts steepening that you get the recession. Why is that? Because mechanically, that's when the credit problems start to occur. And then the Fed has to lower rates. in response to that, but you have a lot of written off debt coming out of the system simultaneously. So that was 12 months. So when the tech bubble burst, that was 12 months of inversion from the first inversion to the start of the recession. Now, in 2008, we all remember the financial crisis. From the first inversion to the start of the recession was 27 months. And incidentally, there was more pain just statistically or empirically with the longer inversion. So guess where we are right now? We're just at that 27-month mark. So if you believe that the mechanics, the whole thing about the uninverting, that sort of starts, the credit issues, right? Then you look at the three things that have kept us from having credit issues, and we have to ask ourselves, are those three things going to continue to be sustainable in preventing what would mechanically otherwise be a recession? And so that's the question that is out there right now. And I don't perfectly have an answer to that, but I will be watching, basically the spreads, the corporate credit spread, to see if the spreads start widening, which is indicative of a crisis. I'll be looking at the high yield spreads, and I will be looking at sort of the swaps in the yields market, and just watching these indicators to see if anything pops. And then also, continuing to watch the Fed indicators and the labor markets to see if we have a recession. If we have a recession, what's going to happen to real estate prices? The system's going to shrink if we have a recession, right? Because you're going to have monetary and fiscal policy responding to that. As far as the refinancing that's going to occur in CRE, we've long been predicting that that's going to be the end of the world. And, we haven't seen that yet. If we don't have a recession, particularly, with housing, you're going to see the supply and demand still, affecting prices. Basically, if we don't have a recession, you're still going to have really high prices because you have really low demand, and now you're trying to put more people than ever in these houses. And really low supply in the face of very high demand. And so you're going to see these prices continue. By the way, that is the thing that has not disinflated. Housing has not disinflated at all when these other commodities have shown some disinflation in them.
It's important to note that this is a regional thing, though. Every market acts on its own, and so where you're living isn't going to apply to the entire United States. Is there anybody else who wants to comment on that?
I'll take a first crack, and then would love to hear from other folks. But thank you to Francis on a great overview. Sort of my view of the world is two possible scenarios, called soft landing and then recession, right? That's the forward outlook, one of those two scenarios. So a lot of data points towards a recession, all the factors that Francis mentioned. But if we don't have a recession, we have soft landing, Fed's going to cut anyway. So the speed of the cuts and the ferocity of the cuts just going to be slower. And if we have a recession, they're going to have to take out their workbook and work a little more aggressively. So there's only two outcomes. And for commercial real estate, most folks on this call are focused on commercial. So it's going to be good news from the interest rate cuts, just this, how fast and how much, we just don't know. Beyond that, I think this is now light in the tunnel. We've been higher for longer for too long. And it's been a tough environment. If you're trying to refinance or you're trying to acquire new, financing has been more difficult to get, lower leverage, debt service coverage ratio constraints. So on a forward basis, things look, at least to me, meaningfully better with the likely recession ahead. It's almost to the point where I've said this before. I don't wish for recession. I don't want anybody to lose a job, but at the same time, we need a little bit of that. The economy actually needs to go through these real cycles, and a little bit more unemployment, a little bit more layoffs would significantly motivate Fed chair to act, and that will be significant tailwind for our industry. It's that simple. So as yield curve inverts, this is a clear sign of likely recession, and it's almost like, well, we've been waiting for it for a long time. Where has it been? Can it finally come? A little bit of that. So that's my 2 cents.
Yeah, I think, like I said, again, I mean, I want to kind of ask around in this panelist discussion, what are you seeing in your areas? I mean, does it look like we're going into a recession where you live? Because I live in Austin, and I mean, things have really I hear a lot of layoffs. I see so many houses for sale. Prices have gone down quite a bit. It's a little, it's just very different here than it is in a lot of places. I hear about Florida having a lot of issues too. So this is cyclical in different markets. I know that. And so it's about time, but there's a lot of different things happening in different places where you're probably seeing a lot more industrial growth in Texas, and you'll see a lot more, self-storage in Texas because all these places were people were coming here in Florida, and then there was hurricanes and you need self-storage for that, and then you need shopping for all of that. So it makes a difference, but we're kind of slow to react in real estate, I guess. And, we're just now catching up with what the demand was during COVID for new building and things like that. But Paul, how are opportunities in preferred equity shaping up in mobile home parks and self-storage and the anticipated rate cuts? What do you think their effect's going to be for that?
Yeah, I think I wanted to answer your first question first, and that
Okay.
was, what's the economy looking like here? I'm in Little Lynchburg, Virginia. We moved from Detroit when we sold our company, and we never boomed like Austin, and so we really have not seen any slowdown. But as far as investing in general, Warren Buffett and Charlie Munger claim that they never had a conversation about the economy ever when they made an investment or a divestment in, something like 55, 60 years of working together. And, they said that they were just looking for great, durable products run by great management teams at prices far below their intrinsic value. And, Munger said, price is what you pay, value is what you get. So, I would encourage you as investors to be looking for those types of opportunities in good markets, in bad markets, in sideways markets, etc. Preferred equity is, Mike and I have talked about it a lot. It is theoretically lower risk way to capture limited upside. So while common equity has unlimited upside, it also has it's in first risk position typically. And so preferred equity right behind debt typically has no lien, but it can often, and we often get a signature, personal guarantee from a very wealthy, well-heeled owner, GP. It typically has a ongoing coupon rate that would provide cash flow and today we're seeing cash flows on the order of 7.5% to 10%, and then an additional 5 or 6 or even 8% upside, getting a total coupon of 15 to 18%. And so with that in mind, and that's for not for rescue deals, not for development deals. Mike will tell you that you can do much better than that for development. And I don't really know anybody that does rescue deals. We sure don't, but I imagine that coupon would be much higher. But we think with interest rates coming down, two things will happen. Number one, the loan covenants, lending restrictions that are there now will loosen. Number one. Number two, DSCR will be less constrained. And then number three, the folks will start thinking this is a little bit more back to normal. So I would guess the demand for preferred equity will go down, and the coupons will certainly go down as we head into this upcoming era. But I would be really curious to see what Mike and others think.
Yeah, I'll chime in real quickly. I mean, Paul, your commentary around investing, exactly what I was going to say. I mean, I love the conversation. Francis, we've never met. I love the conversation around macro and interest rates and the Fed. It's all really, really interesting. I'm a simple real estate investor. Like I invest in good times and bad times. Our goal is to invest in good real estate, good markets with good demographics. that has all the, kind of products that create good real estate, and buying real estate at attractive valuations to the risk in those deals. And I don't care. I mean, I care, but I don't. What happens in November, whether it's who wins the election, I don't think has zero impact on how I'm going to invest in real estate. And whether the Fed cuts by 25 basis points or 50 basis points or 75 basis points, I will certainly follow it and make sure that I'm smart on it, but I don't think it has any impact in how I look at real estate. I think there's good real estate and good investments in up markets, and there's good real estate and good investments in down markets. And maybe I'm being simplistic and naive, but that's certainly how we look at our portfolio and our investing strategy. On the pref is kind of interesting, because we have looked at pref also, and what we have struggled with on the pref side is risk and return. My view is, and Mike and I have talked about this, the deals that I see that are where you can get an 18 are the deals where I feel like I can't properly underwrite the risk. And there's plenty of pref capital out there that's charging, 13 and 14. And that's what we struggled with in that market, because 13 and 14 is not interesting to us. It's not where our cost of capital is. And to get that, there was just too much competition. And so you kind of go to the 18% deals, and we looked at those deals, and from either a structural perspective or a sponsor perspective, a risk perspective, whatever it was, we just could never get comfortable with the deals that were willing to pay 18. Anyway, that's you're certainly much more into that market than I am. You have a much more refined view, but that's just kind of what we saw when we were kind of poking around the pref market. And we have utilized pref on a couple of our deals, not a lot. And we've been able to get deals in the 12-13% range. So I kind of felt like that proves our point that with the right sponsor, thankfully, and with the right real estate, et cetera, we were able to drive down that cost of capital.
So Chris, are your clients adjusting their strategies with the falling interest rate anticipation?
Not really. And I think the reason is because a lot of the things with the interest rates, it's kind of like a wait and see sort of thing, right? I mean, when you try to speculate, when you try to foresee the future, that's usually when you start making bad calls. That's what happened in commercial real estate, right? Everybody's thinking, what if the rates stay like this forever? They stay low, and then we get burned when they start rising. Of course, it was a lot faster than people expected, but that's the thing. When you try to forecast all the time, you get stuck. So instead, what we've been looking at, and even about recession, right? Whether it's called a recession or not, there is no doubt things have been slowing down. There's that phrase that says that, the bigger the party, the bigger the hangover, right? And so what I've been having our clients look at instead is, where are the places we've seen the biggest party, right? Where has there been a lot of inflation in that sense, right? And overinflating in that sense. So for example, I mean, we're already seeing right now in the retail and the food space, I mean, Chapter 11s are being filed daily right now, right? Like that is contracting. We've already seen tech space. Like you mentioned, Austin, I'm here in Utah. We got Silicon Slopes over here. There's people getting laid off in the tech space, the finance space, banking. I've had clients laid off in banking, and most of our clients are nationwide. So we hear about all this stuff from different corners. But those are the places that obviously made the most money in those times. And it's a lot more speculating that happened. And so, what we really look for is, what is everybody talking about? Like, what does everybody think can never go wrong? That's usually where you run away from, right? So like right now, I believe the stock market's drastically overinflated, drastically overinflated. And hardly anybody, other than maybe some of us here, hardly anybody's talking about, hey, watch out, we're at all-time highs. It's way above the long-term yield, the actual long-term trend line that we have. The S&P trend line should be right around 1,800 right now. And we're up, over 5,500. So there's a lot of just overinflation in that space that you're not seeing the general media talk about it. And if the general media isn't saying anything, then you know that's probably the thing that's next to collapse, right? So that's what we're looking for, right? We're looking for where are the places that people say not to get into. That's typically the places to get into, right? It's that Warren Buffett thing is when everybody's greedy, you become fearful. When everybody's fearful, you become greedy. We're just looking like what's the opposite? What everybody's saying in the media, what your brother-in-law is saying down the street, do the opposite of them, and then you'll probably be right.
Yeah, there's a lot of questions that were submitted that some of these things are hinting at, but I don't want to throw off the conversation here too soon. I just want to know, like in general, could lower rates bring new opportunities for refinancing, acquisitions, and commercial real estate? And how can investors best position themselves to take advantage of that? Does anyone want to go first?
I mean, from our view, I don't know, and Mike and I have talked about this before. We like choppy markets. Like we feel that's where there was opportunity. In 2021, as an example, when interest rates were close to zero, and you can finance anything, and the banks were liquid and all that. Like that's not a great market for guys like this, because we're then competing against everybody else, and there's too much capital flowing in. There's too much competition. Like we like choppy markets. I personally like higher interest rates. I know, and I know I'm probably in the minority here, and you guys are all gonna yell at me for this, but I just feel like in markets like we've had over the past year or so, the average investor, or the investor who does not have the liquidity or the capabilities, they leave the market, right? It becomes less liquid, and for the folks like us on this call who have platforms and capabilities and relationships and capital availability, that's the best time for us to be investing, in my view. So I am not rooting for massive interest rate cuts, because the capital is going to flow in, and then I'm competing against 100 guys on a deal.
Yeah,
let me just continue Rob's discussions, because it's almost just a train of thought. Rob and I chatted on this before. So when open air shopping was disliked, out of favor thing, he did a lot of that. He was finding great deals. And now multifamily got beaten up. So the last deal that you guys are closing imminently, I'm not going to talk about it, but it's kind of funny that thing used to trade in the cap rates in the 4s. Now it traded in the 6s. So the market correction and the higher rates have been great opportunities to buy. So from that perspective, it's if you're strong now and you can pick up deals now, you're getting pretty great deals. Again, I think Chris, you said, be greedy when Warren Buffett said, be greedy when others are fearful, be fearful when others are greedy. There's significant fear now in multifamily, and that it's one of the asset classes that's been beaten up pretty bad. So if you can come into that and pick it up at the right price, and you know what to do with it, there's a good old wisdom. And this goes back to the 80s, and I don't know if it's still applies, but at least I thought it was always great. Buy when the rates are high, refinance, and sell when the rates are low, right? We were sort of at the peak of the cycle, of the current cycle. Now we're not going back to the high interest rates of the 80s. Maybe Francis has a comment or two, but the 5.5 Fed funds rate right now feels very, very restrictive. It's Jay Powell said it's very restrictive. So we're at the peak of the cycle. We've just been waiting for him to take action. It sounds like he will take action. And then where we're going to wind up, what's the terminal velocity? What's the normalized rate? That's Francis, I don't know if you want to comment on that, but where are we going? Like how far down can the rates fall from here? Just curious.
Oh my goodness. Well, it just depends on those other 3 factors and how much liquidity comes out of the system. It depends on whether or not we have credit issues and, largely a recession. And basically, there's a couple of things of why, other incentives he's had to bring the rates up so high and hold them up so high for so long. Number one, he's got a lot of dry powder to move rates if the economy falls apart. which in the zero interest rate environment that we had for so long post the financial crisis, he didn't really have that, which gave birth to quantitative easing or asset purchases, which created a lot of the bubble making. And then the other incentive is to keep demand in the bond markets, because as the U.S. balance sheet gets more stretched, let's call it, you have an increasing worldwide incentive to get away from the U.S. Securities, and the U.S. dollar in general. So you have a lot of even European countries looking to join the BRICS alliance, which threatens the U.S. dollar as the world's reserve currency. If we were to lose that status, I'm not saying we're going to or we're not going to, but if we were to lose that status, there's a lot of momentum moving away from that. We would have sort of a third world type balance sheet. So losing the world's reserve currency status would take demand out of the bond markets. If you're going to continue to spend fiscally, the government's got to borrow increasing amounts of money. And by the way, I didn't even realize this until listening to Judy Shelton, but since the Fed started raising rates we have a side gallery over here. Since the Fed started raising rates in March of 2022, basically, the Fed is paying the banks on the reserves that they have at the Fed, right? And they're paying them over 5%. The Fed has paid the banks almost $500 billion. So if you think about our interest, on our national debt being $1 trillion, they've paid $500 billion to the banks. Well, what does that mean? The more they pay the banks, the less they have left over to remit back to the Treasury, which means the Treasury then has to borrow even more to keep up with the fiscal spending. So Jay Powell has every incentive in the whole world to keep demand in the debt markets and the bond markets, and that's why I think he's going to do the minimal that he possibly can. And I'm in the 25 basis point camp in September because the labor market is deteriorating. But those are the reasons. And so what does that portend? I don't know how far we're going to have to go down. It depends on the credit markets.
Thank you.
Yeah. So
any comments on the industrial side? Just curious, from the industrial side perspective, what do you guys see? Are you seeing great opportunities with the current environment? Just sorry, Deanna, I'm just chiming in. Neil has been quiet. I just would love to give him an opportunity to give us his view. Maybe Jake too on self-storage.
Yeah, so in the industrial side, really in the net lease space, we kind of optimize around really a yield which is derived from the spread on cap rates and interest rates. So really in our world, we are almost an alternative financing partner, meaning as outside interest rates go up, buyers are more inclined to sell at a much more fluidly increasing cap rate. So, I mean, we've seen one of the best buying opportunities, probably in the last 10 years over the last, 6-9 months here. From a basis standpoint, properties that would have traded around low 7 cap rates, we're getting, mid 8s, high 8s. We feel right now is probably one of the better times we've ever had to buy at least on the industrial side here. And on the interest side, I think it depends what kind of debt you're putting on. So if it's fluid or if it's fluctuating, there's a lot more near-term risk. In our product type, we're able to typically lock in 5-7 years of fixed, and that might be scary, but you have upside if rates go down. You can refi, and if it doesn't, you're a little more protected on the next couple of years. So, and then the other thing I wanted to add was when rates are low, for example, in 21 and early 22, we were not competitive. We play against much larger REITs in the net lease space, 10, 20x our size. They have lower costs of capital. Simply, we got outbid on everything. We sat, there's a period we sat 4 to 5 months and we didn't buy a single thing just because the numbers could never work out. But right when those rates actually started increasing, that kind of a turmoil in the market, a lot of the larger buying groups out there sat on the side, and we found, at least from our perspective, some of the best buying opportunities at those transition points that we've ever seen. So those are things that are attractive to us. In hindsight, I think we can stand by that. Those were some of our better buying opportunities.
How about Jake's storage?
Well, we've this is through last month, but we've looked at 882 acquisition opportunities this year. We've financially modeled about 250, and so far we've closed on one. So we're doing a real good job there. The good news is we've got 3 or 4 actionable deals that are either under LOI or under contract in the pipeline. And we are certainly not seeing what you're seeing, Neil. I mean, that's a big change and going in yields on costs and cap rates. Most of the deals that we're seeing right now, I would say we're underwriting with what we believe to be conservative, reasonable assumptions, mid-teens IRRs over a 5-year hold, roughly a 2x multiple. We're assuming reversion cap rates in the mid-5s to 6% range. But yeah, we're not seeing, and careful what you wish for, but I think a lot of us on this call right now were kind of hoping and maybe predicting the old debt maturity wall a year ago, right? Oh, we're going to clean up. It's going to come off the rails, all these debt maturities. And to Francis's point, there's so much liquidity in the system. Banks are modding loans. There's pref equity, there's rescue capital, there's mezz debt to bring in. So that pain hasn't emerged. And we're not seeing that on the deal flow front either. And just like you, Rob, there's never a good or a bad time to buy. There are deals that have risk-adjusted returns, and there are deals that lack risk-adjusted returns. And I'm not sure if we're going to ever see this maturity wall. You know, I screenshotted a headline from the Drudge Report 2 years ago with a big stop sign: recession imminent, rich shedding assets, cracks in the job market, and look what's happened, right? Nothing. It's gone the opposite direction. So the acquisition opportunities that we are seeing are just, I think, really a result of just generally a lack of market efficiency, unsophisticated operators, unsophisticated sellers. It's pretty rare that we see an opportunity that's directly attributed to a debt maturity problem or a refinance problem. It's just somebody doesn't really know what they have. They're not running it well, and we can perceive value creation by running it more efficiently. So I wish I was telling the same story that Mag is, but I'm not. Deal flow is better, but we're certainly not seeing obviously better pricing than we were a couple of years ago.
Yeah, we're seeing the same thing in the retail market. Just real quickly, it's become very, very competitive. All of a sudden, you know, everybody 5 years ago was convinced that retail was going away, and now everybody loves retail. I don't understand how this stuff happens so quickly, but it does. And there's just too many buyers right now. Too many, and you know, as you said, Jake, some bigger buyers, institutions, public companies who are now liquid. And we have not bought a retail asset in 12 months. And you know, we're trying, we're bidding, and we just keep getting outbid. And we're not getting outbid by 2, 3, 4%. We're getting outbid by 10, 15, 20%.
We're getting blown out of the water. I mean, we're talking a $8 million LOI that we put out, and it trades for 10.5. It's just incredible.
Yeah, I don't understand the underwriting. I don't understand their cost of capital, or at least the returns that they're underwriting to. It doesn't make sense to me. If I just take our underwriting and put their number in, I was like, okay, if somebody really wants to buy for that yield, then go for it. I don't get it.
Well, we can make our models tell us whatever we want them to.
It's true.
I'll just add one comment, and maybe Deanna continue with the regular scheduled programming. One of the discussions I've had with other folks was changing the underwriting assumptions from a couple of years ago versus now. Some folks said, I've heard this point of argument: we still want to have our old-fashioned, disciplined assumptions. But a few years ago, that old-fashioned, disciplined assumptions were more aggressive, and now we actually back to the more real conservative assumptions. So I'm just curious, any quick thoughts if you're still underwriting your deals similar to a couple of years ago, or at this point you've tightened up, are more conservative just because things have changed? Just a quick comment, and then we'll go back to the regular schedule program.
Warren Buffett and Charlie Munger said that they never had I already said that. Yeah, we're not doing anything different.
Okay, fair enough.
We aren't either. We're underwriting the same way we have for the past 8 years.
Jake, Andrew, Neil, you guys
Yeah,
are still
same.
maintaining same discipline?
Yep, the same.
Yeah, we're less stupid than we were a long time ago, and our models every year get a little bit less wrong. So pretty similar underwriting overall.
I think that's a great wisdom. The words of the wise man, we are less stupid. That is as wise as it gets. So thank you. Thank you, Jake, for being vulnerable.
Yeah, no, I mean, we're all making assumptions on cap rates and NOI and revenue 5 years from now, right? We're making an educated guess and we're trying to be reasonable. But we're always wrong. Hopefully we're wrong in the right way more often than not.
Yeah, one of the questions that was submitted before the webinar is where do you think cap rates are going right now? And I think it's a different answer in every asset class.
Let's go around. Let's go around the block. And what do you think is going to happen with cap rates?
I can't resist. I'm going to start here, but I promise to be brief. This is a conversation that a lot of us, I think, have with investors, and it's got to be so contextual. What's a cap rate? Whose cap rate is it? Is it the brokers? Is it, well, what cap rate are you buying at? Well, if I'm buying a deal at 20% unit occupancy that just opened, I'm buying it at a negative cap rate. So the cap rate we look at, or the yield on cost, or the NOI divided by the cost basis, we're looking mainly in the future, maybe 3 or 4 years in. What are we solving to from a stabilized yield on cost perspective? And to actually answer the question, and I'll stop speaking for a moment, you would infer and you would assume that cap rates have increased and expanded because of the environment we're in. Rising interest rates, right? You do the math, cap rates have to go up. That's true in a lot of markets, and it's true in some asset classes. I think CBRE released a report that multifamily cap rates have gone up from mid-4s to mid-5s. That's a broad stroke statement, though. But we're still seeing deals trade that we consider fairly stabilized under a 5 cap. So again, do the math there. You're financing at a 6.5 or so, and you're paying a 5. How does that work? And I guess my conclusion in that commentary is, I don't know. I don't know where they're going. We're trying to be reasonable, conservative, not lever too high, not lever too low. Take today's perceived cap rate, add a point or two onto our exit cap rate. That drives our model assumptions. But I don't know where they're going. Hope that helps.
I don't either.
That's a crystal ball, broken crystal ball answer, and that's a wonderful answer. So thank you, Jake. Rob.
Yeah, that was good. Someone else asked, what are the undervalued investment markets, and that will turn around in 5 years. And I think that's another crystal ball question. A lot of the questions submitted, I wish we knew the answers to. I mean, I'm going to keep asking them to this panelist, but I don't know that you'll get an actual answer for a lot of these questions. So let's dive into the data-driven strategies for navigating the economic shifts. So what key economic indicators are you currently tracking to guide your investment strategies? And let's start with Paul.
Honestly, we are, again, it's the same thing. So if Buffett said, I'm looking for durable products, great managers, undervalue, intrinsic value deals, we're looking for great operators we can invest with in great asset classes who are finding undervalued, intrinsic value loaded deals. So really no different than any other time.
Chris, do you have a comment on what key economic indicators you're currently tracking for your?
Yeah, last several years I've been tracking more like the yield curve, obviously. So watching on a daily basis is pretty boring, but he actually got exciting recently, right? Been watching also the M2 money supply, what's really happening there, because like Francis said earlier, that's the real determining factor of, is this going to be like a soft landing, or is this like a slow crashing, right? What's really happening here, right? So I'm watching a lot of those indicators, but for the most part, if I ever watch anything with media, it's more whether the general public saying, so that I don't do that. That's pretty much what I watch. And I'm of course watching employment numbers and things like that too.
And just curious, so is anybody, the panelists, are you able to see the questions being asked? Okay.
Yeah.
Is that, okay, good. So, if you have a chance to answer any of these, guys, go ahead and chime in. I guess I'll move on with the same thing. What economic indicators are you currently tracking, Mike, for your investment strategies?
So one of the basic things that I've discussed on a couple of actually podcast episodes is new supply. And then in various industries, it's been a significant concern. It's all regional, of course. We've seen a lot of record deliveries, multifamily, some storage. I'm not sure about industrial. Obviously, open air shopping has been significantly under constructed. The new products hasn't come in. Multifamily, we've seen a lot of new starts when the interest rates were low. Deliveries are coming through now, but they intended to come down in the let's call it second half of 25 into 26. So a new supply makes a difference in some markets, and that's one of the reasons that some of the Sunbelt markets have suffered on their negative rent growth. In some cases, we've seen. I think they're not called storage wars; they're called storage REITs wars. But the pricing with oversupplied markets, the REITs have been competing brutally to get occupancy on what I've heard on the storage side. Like it's all regional, it's all market driven. Multifamily has been oversupplied, I think, in Austin heavily, Phoenix, number of other markets, parts of Florida. And then the supply, and this is not just multifamily, it's also some housing units, 1 to 4 doors. So those factors could impact at least rent growth for the next few years. So rent growth assumptions have to be more conservative. But 26 and beyond, the expectation is, again, less new supply. There should be improvements. And then obviously looking at the more steady Eddie markets, don't see this kind of volatility Midwest. So data driven could mean many things, but at least on the new product side, it's something you can control. You could understand the markets a little bit more of from a supply demand equilibrium standpoint. We're just chatting about another project in Gainesville, Florida, student housing. 5% of additional supply came into the market. 5% of additional supply is actually quite a lot, and it can soften vacancy. It increases vacancy. It decreases the pricing power. So these elements could make a big difference. At least that's just my 2 cents.
One interesting economic indicator that maybe a lot of people don't have visibility in, but that we work with a lot in the industrial sale leaseback side, is the percentage of acquisitions that we look at, opportunities that have a private equity execution happening at the same time. So just to use some numbers, about a year ago, we were only seeing about 20% of the sale leasebacks were being driven by M&A activity on the other end of the transaction, whereas now it's a little closer to about 50 to 60%. Takeaways on that could vary, but one theory is that a year ago a lot of folks were doing sale leaseback because they needed liquidity, and now it's a little more tied to the M&A side, which is a little more growth minded. So just kind of an interesting empirical piece of data there.
Anyone else want to comment on that?
I think just to leverage off what Mike said. I think what Mike was saying is that real estate is a local business, right? You make the opportunities are local. The macros are certainly, again, interesting and important to think through. But at the end of the day, what really drives successful real estate investing is buying good real estate in the right markets where there's the right supply demand dynamics. Whether it's, and whatever is driving demand, income growth, population growth, things like that, and what's ever driving supply. And I agree with that. I think that, again, my view is that you can make money in up markets and down markets, because if you're buying good real estate in where there's the right, ratios of supply, demand, and all that, I think will do well. So that from in the retail world, we're certainly look at that. We look at demographic shifts. We're looking at population growth, income. We're looking at education levels of people who are moving into certain markets. And then we look at supply, and again, on retail specifically, there's been very little supply, which is one of the reasons why we like that market. Since the global financial crisis, if you look at the statistics, there's been almost no net growth in retail supply nationwide. And so if you're in a market where you have good population growth and good income growth, and you have industries moving in, and you have no supply growth, that tends to create opportunity.
Chris, I want to ask again, how should investors make informed decisions about new opportunities and existing investments?
This right here, what you guys are doing right now. I mean, when you have that kind of mastermind collective, right? When you have multiple voices, and especially when you start to hear those that actually have their boots on the ground, they're actually seeing this real time. That's the best way to do it. That's why I stay away from the talking heads, right? Because the talking heads usually aren't the ones doing the investing. They're just being paid to be a talking head. It's the people that are actually doing the investments like you're seeing right now. This kind of thing is exactly what you want to be apprised to. And that's a great way to get ahead and to be prepared.
What are your thoughts, Francis?
I mean, I agree with that sentiment. I'm always looking to see if what the daily narrative is around volume and price action is really kind of matching what I'm observing empirically, what I'm observing in my clients' lives and things like that. I agree with Chris's sentiment about the market being completely overbought. I think a lot of liquidity poured into it. The fact that NVIDIA has been holding it up, and NVIDIA to keep going at the rate it's going, the rate of acceleration. And that's not to say that NVIDIA is a bad company, clearly, right? And they don't have the comparative advantages that they're getting paid for. But when they're being made responsible for the aggregate market, you're starting to lose that common sense. And so I agree with that. I just think I like to hear everybody saying that their underwriting models really haven't changed over the trajectory, because I really think that is very wise. And if you really stick to that risk reward ratio and make the math make sense, and I really respect Jake, like he's just not jumping in deals for the sake of jumping in deals. We used to value a lot of private equity at my old firm, and our inclination was always more to say no. And even in our real estate investments, we ran into the liquidity walls and things like that. So I do think that, as far as some of the economic indicators, I mean, just classically, like I'm a global macro person, which is, again, I was full disclaimer on the mental illness of being a Fed geek, right? But, just what's happening in the bond market does say quite a lot. And whether the bond market's agreeing with the Fed or disagreeing with the Fed is very interesting to me. The supply and demand dynamics. I noticed somebody put in the comments section that they didn't think that the US was going to lose the world's reserve currency anytime soon. I hope you're right. There's a lot of momentum going towards the BRICS, right? 33 countries have now applied to join BRICS, and they're really courting the European countries. They're courting the South American countries. Some of the BRICS countries are giving these sort of mafia offer loans to these small island development systems. And I see all of this working in the UN committee space. And if they reach a point of critical mass and we simultaneously have a debt crisis, I think that that's what they're hoping. So I absolutely hope you're right, and you could be right. And I'm not saying that that's happening anytime soon. The US is still the largest holder of gold. Central banks around the world have been buying gold. But the thing is that the dynamics around these things are changing over the longer term trajectory. So when you're looking at, what your longer term scope is of owning these assets, and you're looking at the internal supply demand dynamics and the regional price dynamics, sometimes over the aggregate, they're unaffected by global macro things. And sometimes, they really are. But if you have good underwriting and you don't run out of liquidity and you don't have to desperately seek financing, then yeah, over the trajectory, probably. And I think Warren Buffett was great at that. Clearly.
By chance, is anyone seeing acquisitions from international investors? No? Are you seeing more international investors coming into your investments? No?
We're not set up for that, so we don't talk to any.
Oh. Okay. Well,
I'll let a quick comment on this. So we work with some folks from Australia. We have some folks from Canada, and other ones. So there's certainly international capital that seeks diversification and US-based opportunities. But it's all relationship driven. It's not a macro view. It's more of a, let's just call it, specific relational view. So we're seeing a little bit of that. One thing, I'll just add one more comment, and again, this is China specific. We work closely with another fund manager who's Chinese, and she's got great, or she's a top, let's call it, YouTube channel for Chinese, US based, and she's gone to China. Some really interesting. China seems to be in a very, very strange state. It's another conversation. They're rising power, but they're having all kinds of economic problems. Maybe driven by the centrally planned economy, etc. But where am I going with this is that certain countries with their political system and uncertainty of safety of the capital there still seek to move their funds over to the US. The biggest problem for Chinese investors is not that they really want to invest in China, they want to invest in the US. But the difficulty is the Communist Party is blocking them from moving the funds over. That's a perpetual problem. So there's certain, let's just call them geopolitical issues, but even China's rise is something that not everyone wants to invest where they're making money. In fact, US continues to be one of the greatest places to diversify, even with all our challenges and difficulties, et cetera. So that's my observation.
Yeah. So just around the room, are you seeing more investors want to preserve their capital or trying to look for a new deal and jump in thinking, they're getting a great opportunity on a deep buy?
I'll address that since I see that quite a bit in my space, because they're coming to me looking for your guys' kind of deals, right? I see a lot of people being very apprehensive, like they want to be careful. They want to invest. They're just like, well, where can I go that I have some certainty? And the truth is there's risk everywhere, right? So there's a lot of that. I need to do something, but I just don't feel confident enough to do X, Y, or Z, and so that's what I'm kind of seeing right now is that people, the euphoric conditions I saw 3 years ago are definitely not happening today. Now people are kind of leveled off. They're kind of calming down and saying, okay, let me take a breath. What's next? Where can I place my money to ensure that it's going to come back to me? And that's why real estate's a great place to be, or it can be a great place to be, depending on what you're doing and how you're diversifying it.
Rob, were you going to say something on that too?
Yeah, I was gonna say something similar. We're seeing mostly risk off right now in our investor base. It definitely feels like people are less interested in taking risk right now, and there's a lot of, I think there's maybe a number of things going on. Maybe liquidity is a little bit down for some of these people, and they haven't gotten their capital back on some previous deals that they anticipated getting capital back. So their balance sheets are maybe not as healthy as they anticipated, and so it definitely feels like there's a risk off. But then again, there's still liquidity out there because we're raising capital for a deal right now, and there's good demand for it. So it's a little bit of I think a little bit of a mixed bag, but I think it's certainly more risk off today than it was 2 years ago.
I will say that we've done some preferred equity sidecars to our main fund. And while we're raising money, kind of slowly in the fund, when we've done sidecars that were just one deal, preferred equity, theoretically lower risk, but limited return. The first one filled up in 3 business days. I think it was like 4.5 million. The second one was like 5.5 million, and it's filled up in 20 hours. So I think that the demand based on that is for the lower risk, just based on that little one data point.
Yeah, I'll let a quick comment. Thank you again for the great sharing. In general, absolutely risk off, especially from folks who have been beaten up. Last couple of years have been challenging in number of investment strategies. Sometimes it's strategy, location, operator, etc. but the last few years in commercial real estate have been years of pain. And not everywhere, some deals, the amount of pain, we were sort of infallible. Everything that worked since 2000, great financial crisis, 2008-9, the recovery has been long and strong. And then things changed in the, let's just call it post-COVID, higher for longer interest rates, right? So folks who have exposure to them, Rob, like you said, their balance sheets are, they over stretched. Liquidity is tight. So for those folks, it's how can they increase liquidity, and if any new checks, they have to be ultra safe. But what's interesting is folks who are coming in new into the investing game, for whatever reason, they've not been exposed last couple of years. They've been in stock markets, they want to diversify, they've done well, they're thinking, well, what else can I do? Well, these folks a very different experience. So yeah, there's a little bit more greed happening there for the reasons that they just don't have the same level of problems. It's a very bifurcated and different experience, at least in what I've seen with investors. Old investors behave with problems, with challenging deals, behave drastically different versus folks who have nothing to be concerned about of the past. And from a market cycle perspective, again, we didn't talk much about the cap rates and where we're going, but in general, I just want to add two comments. Literally 2 days ago, I interviewed chief economist of BGO, it's a significant real estate investment shop. And he was really excited about opportunities ahead. And really, of course, interest rates going down can give us substantial tailwind, but also risk premiums should be contracting. Something interesting that risk premiums are very high right now. Spreads representing the risk should be coming down. I don't know, maybe Francis, you have some thoughts on this. The forward outlook, is there a pattern when the interest rates go down? Is typically risk premiums soften? Just at least that was the observation. All of it is speculative, but the feeling is, again, lower rates should mean some kind of risk premium reduction as well as overall pricing improvements for commercial deals.
Yeah, just generally speaking, I think it just depends on why rates are going down. Has a big deal with whether how you price and risk premium. Also, I think there is a little bit of complacency in the fact that we've had this amount of tightening without a real recession, and I do think at some point there will be some hangover to the party, but I think that there is some complacency stepping in because people expected the wall to maturity, which didn't manifest in the way that we thought, and we've sort of now we're in the soft landing camp still, or no landing camp or what have you. And so unless that changes, I think you will continue to see risk premium fall.
Thank you.
One of the questions submitted, actually a couple of them, are asking, how far do the rates have to fall for it to make a great impact? And how soon would that impact be for the distressed assets in commercial real estate? I mean, is a 0.25% going to make a big difference?
I don't think a 0.25% is going to make much of a difference. I don't think you're going to get a real change in things. There's a lagging, effect to these things. You've got bond markets are trying to anticipate where rates are going, but some of these actual deals and, big purchases, especially illiquid things, tend to lag that. And credit cards tend to lower rates on a lag, and, mortgages tend to adjust on a lag and things like that. No, I think you would have to go a couple percentage points to see, to see meaningful changes, basically, because they're going to switch them on a lag. And by the way, I've seen some indications that potentially inflation could reaccelerate into the end of the year or stop the rate that it's falling. And I'm not sure that that's completely priced into the market either. So no, a 0.25 point. And by the way, there's this great debate is who controls the bond market. Does the Fed control the bond market, or do bond investors control the Fed? And really interest rates are, the Fed sets the discount rate, but interest rates are traded. And the thing is the bond rate has already taken the rates down. So, and we haven't seen, big changes except maybe a lowering in the risk premium, things like that. So these rate cuts get priced in, and it's only if we're wrong, 40% of the market thinks that he's going to cut by 50 bips. I think he's going to do a quarter point unless he has a reason to do 50 bips, which I don't see. So then you get the mispricings and you get the volatility. Well, that's short-term volatility in the markets, which are driven by options trading and things like that. It takes a longer lag to have these rate changes affect, things like commercial real estate or deal flow.
And just for clarity for some people, because they might not know this, but how does the election affect how the interest rates and the Fed acts?
So there is speculation that Trump has, he's going to create an executive order that the administration has to approve interest rate adjustments. I have no idea if there's any truth to that whatsoever. One of the things when Trump first got into office in 2017, I know that I had a television thing that went absolutely viral when I said, if the Fed raises rates, at the time it was Yellen, too aggressively, they could undermine his administration. Obviously, not thinking with COVID. And so if there's any truth to that, it's a lot of speculation, but I think basically the election's not going to necessarily affect what the Fed does in the near term. As far as the Fed will be reacting to internal dynamics in, the liquidity flows around the world and markets and debt markets and things like that. In the longer term, they're supposed to be independent. I don't know. Hard to say. But if Trump does change that law, and I don't know if that's for the good or for the bad or for whatever, I think that would dramatically affect things, because I think he would have incentive. He has an agenda: lower regulation, lower taxes, and I think he would then want to align interest rate policy with the agenda of his administration. But I don't know what that would look like.
Can I chime in on this? Thank you, Francis. There's a lot of brilliance on that, and we have this short video we put together where I talk about who is more powerful, the president of the United States or the Fed chair, right? It's a great question. So right now, I believe it's the Fed chair, but if U.S. president has the overriding power, then guess what? That whole Fed independence changed. So hopefully it doesn't happen from that perspective. We don't want presidents setting up monetary policy because it fits their political agenda. That would definitely be a problematic. That would be a move to more of a China-like environment where the Communist Party dictates everything. So we definitely don't want that. So that's my quick comment. And then one more comment back to Deanna, to your question, or whoever asked the question, how many cuts we need to get to a better place, right? That's the more fundamental question. So one cut for sure, whether it's half a point, a quarter, not going to make material difference. It's a cumulative effect of multiple cuts, right? So if you're sitting on floating rate debt, whatever mortgages, on value add projects, they're sensitive to the rate changes. But one cut, two cuts are not going to make a difference. Although if you go out 6 months and we see, let's for the sake of the argument, 4, 5 cuts, 1%, 1.5%, 1 quarter. Again, I don't know if we're going to go that fast or faster or slower. It depends on what happens in the economy. That's pretty meaningful. If you add up cumulative effect of multiple cuts, it's almost maybe Francis, you can comment again. I go back and I think how fast they hiked. They hiked like the movie Too Fast and Too Furious. They hiked so much so fast in a year and a quarter. They hiked from 0 to 5.5 in like the world was ending, or the other way around. That reverse effect could substantially support valuations and liquidity within the commercial markets. It's just that's a question of just size of the cuts. So what I'm thinking, again, I may be wrong, but I'm just taking 2-year outlook. Why 2 years? Because like Francis, like you said, everything has long and variable X. What Fed does, it takes time. So in 2 years from now, a year and a half from now, where are we going to be if we are 150, 200, maybe even 250 basis points lower than where we are on the Fed funds rate, and the bond market has its own adjustment, could be meaningfully better. So nothing too fast, but with the 1.5, 2 year time horizon, it feels like we could be in a meaningfully better place. That's my 2 cents.
Yeah, I just want to interject one point. It depends on what like, let's say we take 2 points off of the interest rates, right? It depends on, like you said, the rate at which we do that. And it depends on if it's attendant to these other things, like the fiscal spending. Do we have lower rates with still the same amount of fiscal spending? Do we have lower rates with substantially less fiscal spending? You know, like if Trump got in there and really cut the spending. Do we have lower rates? The lower, rates going down obviously is going to change the credit, the private credit, dynamics as well, right? Now we have private credit ETFs coming out and things like that. That's signs of a bubble, right, Chris? It's a little popular. So, do we have all of this private credit attendant to that rate drop, or does this really, like, the private credit dries up a little bit and the banks come back in because rates have dropped? And do we have, what does that mean for, individual borrowers? Are they still so maxed out on credit cards that they can't get new credit because they're just so maxed out and it doesn't matter that rates have dropped? Or does it change the debt service on their credit cards or other dynamics like that? But really the fiscal spending is, I think, for me, the biggest variable of, how meaningful over what period of time a couple points coming off rates would be.
Thank you. And my observation is we're too addicted. We can't, just a matter of do they take a big dosage of cocaine, a little bit small dosage of cocaine, but the US economy just can't, fiscal responsibility is long gone. It's just how much deeper we go into borrowing, the speed of the growth of the budget deficit and the national debt is just a question at hand. And it's almost if that starts going too fast and the rates are high, what happens? I mean, we're in a sort of a vicious spiral. Maybe if they accelerate the debt growth, are they forced to cut rates to at least keep that under control? I don't know. I mean, just kind of, that's the big question.
I have a question for Paul. Which real estate sectors do you think are the best poised for more growth going into 2025, and what factors are driving this?
I wrote a book on self-storage, but as Jacob can tell you, it's a little tough right now. Maybe in really strange markets like Ishpeming, Michigan, where we invested, in Beeville, Texas, and tiny towns where there's not much competition. But I really think I really like mobile home parks overall, manufactured housing communities. It's the only asset type I know of that has increasing demand and decreasing supply every year. There really is an affordable housing crisis, as I think we all would agree. 10,000 people turned 65 today, but 6,000 of them, according to statistics, don't have $10,000 saved for retirement. Amazing. But a lot of them do have home equity that they're willing to trade in for a mobile home, and they can go rent a lot at a mobile home park for, let's say $300 to $600 a month and live comfortably. It's not just for economically challenged individuals. I know a doctor who was actually very wealthy who chose to go to a mobile home park to give him flexibility, give him a yard, give him, a place he could pull up to the door with his groceries rather than an apartment or a house. And so that's the asset type that I like.
Well, thank you. What about you, Rob? Do you see the most growth in multifamily or retail, or what are your thoughts on this? And then I know you have a meeting, so you can't stay on very much longer, but I wanted to also get any actionable advice or any books you recommend.
Boy, that's a lot of questions in one. So I'll tackle the books one quickly. So I feel like I'm so engrossed in the financial and real estate world, 12, 13, 14 hours a day, that I really need to try to read fiction at night. I just feel like it's the only thing that really relaxes me a little bit. So my latest book is called The Heart's Invisible Furies. Has anybody read that? My wife recommended it. It's by an author named John Boyne. It takes place in Ireland. It's a wonderful story, great characters. I'm only halfway through it, so but I highly recommend. Well, the first part of it I highly recommend. I guess I'll find out over the next couple weeks. I'm sorry, Deanna, what was the other question? That was
any actionable advice, and where do you see, what sectors in real estate do you think have the potential for the most growth in 2025?
Oh, yeah, I don't know. I mean, I think retail is going to remain interesting. As I said before, I think it has been it's gotten too hot, too much capital chasing it, but we'll see if that changes. I think that that multi has been very interesting over the past year. I think it'll continue because I think there'll be some issues, credit challenges and refinancing challenges in multi, and I think that'll create some opportunities. I don't know enough about. I mean, I think office is really, really interesting. I feel like I just don't know enough about it right now. I'm sure somebody is going to really figure it out and make a lot of money in office. It's so contrarian and so interesting. I'm not sure I'm the right person at this moment to dive into office. But certainly somebody's going to make a lot of money there when they figure it out. Who's going into the office and who's not, and which markets are should be the focus.
Well, thank you. Thanks for coming on today. I know this is about an hour and a half into this, so if there's anybody else who needs to jump off for a meeting and you want to be the next person to go and answer this question as far as what are the best sectors to invest in, what your outlook is for 2025, what are some actionable insights that we can share with investors, and then also if there's any books you recommend.
Well, I am going to jump. Thank you, everyone. It was very nice seeing you all. I appreciate it. Mike, Deanna, thank you for inviting me. It's great. Have
Thanks,
a great
Rob.
everybody.
Take care.
Let me chime in because I gotta go pick up my daughter from school, and she's expecting. I apologize. It's just the 4 monkeys and a cat, 4 kids and a wife and a cat. So let me just quickly chime. Book I really like. Sometimes you win, sometimes you learn. Just all about life, right? When we win, we learn less. We learn more from our experience, and the book doesn't say sometimes you lose, sometimes you win, sometimes you learn. So life is a journey and continuous learning. So I really like the book. There's another really good book, Richer, Wiser, Happier. Talks about some of the greatest investors in the world. So these are some of my favorite books. And the secret of all these books is not to go read more books. Read these books again and again and again. There's a lot of wisdom to that. So, and then opportunities ahead. I'll just a couple of quick comments. So it feels like multifamily is trading at a meaningful discount. Again, whole Rob's he left, but when we chatted, his wisdom and discovery was retail is fully priced, hard to find deals. He's finding better deals in multifamily. It feels like multifamily, at least portions of it, are trading for sale. There's no right or wrong, but it just feels like certain opportunities in some markets. But it's all back to Paul, right? If you can get a great deal. And I really like industrial from the point of view that it's just predictable, steady Eddie. And with the political bickering with China, there's going to be deglobalization, more US-based manufacturing. So it feels like industrial could have some tailwind with the more US-based industries. That's my 2 cents. So thank you.
Just one question before you leave, Mike. Somebody asked, and I want to ask everybody this: have you increased your precious metals holdings? This is an interesting question, and I just want to see if you've raise your hand if you have or have not. No? The answer is no.
Do you count crypto?
What?
Do you count crypto as precious metal? Probably not.
No, that's not. Is it even real? So yeah, the answer is no to that question.
I'll add one quick comment, and this is again back to what Chris said and Francis alluded to, right? So what happens when certain asset classes appreciate substantially, like stock market feels to be fully priced, well appreciated. Now gold, I don't have anything negative to say about gold or silver, precious metals. Love, it's a bright and shiny objects, right? They're wonderful. I would rather have those bright and shiny objects than some other bright and shiny objects. But when you have appreciated assets, your portfolio gets overweighted into some of those investments. And certain strategies have been somewhat beaten up. Again, we're harping on multifamily real estate, but certain commercial asset classes have seen softening valuations. So from a portfolio balancing and rebalancing perspective, buying more gold when it's gone up a lot is not necessarily what I want to do. Now, I still love gold. I still have a bunch of them, and I have to say that they're fun to look at. It's fun to own gold. Like Warren Buffett says, there's only one problem with gold: it doesn't reproduce. So owning a bunch of gold is wonderful, but you can't get any cash flow or any sort of benefits like that. That's my 2 cents on gold.
Well, Francis, let's save that conversation for October about crypto and gold, and Mike will be able to host that one for me because I'm actually going to be on an airplane, but definitely want to talk about those things. So I'm looking forward to watching that one. So anybody else, who's next? Who wants to talk on what they think are the best opportunities coming up for 2025 by Mike?
Thank you all kindly. We really appreciate you all, and thank you everybody for watching, and would love to chat more with each one on the panel offline. Go schedule time with me when you get a chance. And thank you all for, I know many of you scheduled to come back on a podcast. So thank you. I'm so grateful. Deanna, thank you for running this panel, and thank you all very much for watching. Hope it was entertaining and educational.
Thanks, Mike.
Thanks, Mike.
So outlook for
I'll
2020.
chime in.
Yeah.
Yeah, I know 2025. I mean, again, I don't have a crystal ball because it broke a long time ago, especially after the last global recession. Unlike Francis, I didn't predict well. I got my butt burned in that one. But I'll tell you, I mean, I did buy precious metals, but that was more in 2020 when the prices were a little bit cheaper. But right now, I'm looking forward to multifamily for sure. Just like we talked about today, self-storage. I've been keeping an eye on that. I know Mag, we've been talking a little bit as well about industrial and things of that nature. I'll tell you right now, my strategy is that I'm not reinvesting as quickly as I was a few years ago. So I'm building up more cash using my life insurance policies to hold it there, especially because now the rates are growing in that place because the bond rates, they have a longer term bond type yield. So they tend to be slower turning, so I'm seeing more there where I have those guarantees and storing that cash, kind of like what Warren Buffett's doing, where he's got almost 300 billion of cash sitting on the sidelines now. He just sold off half of his Apple shares. So I'm doing kind of the same thing. I'm kind of building that cash while still reinvesting. I've been doing a lot of raw land. That's something I've been enjoying the last few years. I'm also looking at even single family again, because it seems like, again, whatever everybody says don't do, that's kind of what I'm looking at doing. And now that the rates have dropped, we've already seen the bond yields drop, even though the Fed fund hasn't dropped. The bonds have dropped really for several months. We're already seeing this change in the mortgage pricing, which increases the cash flow on single family residences for cash flow and things like that. So I've been looking at that, not so much as a good cash flow play, but maybe a more longer term growth play, because I do really believe that, like was mentioned earlier, we're probably going to see prices still continue to increase as time goes on.
One of the questions submitted that you just kind of jogged my memory on is evaluating hindsight. What were some of the indicators in 2021 and 2022 that should have told us to sit on the sidelines? Does anybody want to?
I'll talk again, then I'm done, I promise. But it's funny because 2022 was kind of interesting for me because I remember March was a critical month, right? Because I remember, and Deanna, you might have been there. I can't remember if you were there or not, but we were in a mastermind room where someone said, hey, everybody's saying, get your cash out because we're going to lose inflation. So invest everything. He says, well, isn't that the time we should be holding cash? And I took that to heart. I said, you know what? I should, I should start storing more cash. Everybody's saying, get your cash out. You're going to lose inflation. Then I want to be the one that actually has cash when nobody has cash available. Right. So I've been really building that cash position up more and more the last 2 years. Also, that same month, that was the time when I was listening to a crypto expert. Speaking of Bitcoin, Andrew, I was listening to a crypto expert that said, hey, the Feds, what's their number one goal? People are like, interest rates, inflation. He's like, nope, protect the value of the US dollar. He's like, Bitcoin is a threat. He's like, you thought it was bad with Goldman Sachs trying to price manipulate gold and silver. Watch what happens with Bitcoin. You're seeing it hit 65,000 to 50,000. That's the Feds, with their balance sheet. And so I said, you know what? This might be a time to sell my Bitcoin. And so I did. I sold at the height there. And that's the thing is that it's fascinating to see how those markets manipulate. But again, listening to what people are saying, right? If everyone's saying one thing, do the opposite, or see, if they're going to do that, that's probably bringing an opportunity to sell and get your positions out. So that's what I've learned. I think also looking at 2025, it's the same thing, is what are people saying and what are the masses saying that you should then not be doing?
Great actionable advice. Do you have any books that you recommend?
The one that came to mind was The Road Less Stupid by Keith J. Cunningham.
Yeah.
I'll tell you, I've spent a lot more time having that quiet thinking time. That's allowed me to get more clear on not just my finances, but even just life in general. So that's a great book.
Paul, you're next. Do you have any actionable advice, any outlook as to what is the best opportunities in 2025 and what book do you recommend?
You did say Paul, right?
Yeah.
I would say Richer, Wiser, Happier, which was recommended by Mike Zlotnik. We talked about that on his podcast, I think, once, and also The Road Less Stupid. Thanks for reminding me, Chris. It's on my bookshelf, but I haven't had enough quiet time to pick it up, apparently. But seriously, opportunities. Well, you asked a question a minute ago, Deanna, did we see any warning signs in not to buy in 2021 and 22? We did. I wrote a book humbly titled The Perfect Investment about multifamily. And then I started, really running as hard as I could away from multifamily. Chris and I, you and I talked about that at dinner one night. But I think it wasn't multifamily that was the problem. It was the fact that people believed, as Howard Marks says, that trees would eventually would grow to the sky, which is not going to happen. That's rent growth we're talking. That you could drive operating expenses down in an inflationary environment, that you could pay 20 to 30% more than the value of an asset, as Jake said earlier, and it would turn out okay, and that you could use floating rate debt and that it wouldn't come back to bite you. And so I think that if I had to pick one of those things, it was the floating rate debt that bit so many people more than all the other issues. So that would be the issue I would have avoided. As far as opportunities, pref equity we're seeing now as an opportunity. We're going to be looking at JV common equity in the coming years as pref equity lowers in its, coupon and risk reward profile.
Yeah, I think that's starting to become a more obvious, I guess, opportunity for a lot of people right now. We're starting to see that, at least on what we're looking at.
Right.
So Andrew and Neil, I know I'm categorizing you guys together because you've got to have the same outlook, I guess, as to what the best opportunities are in 2025. And then did you have any warning signs in 2021 and 2022, or was it just the opposite for you guys? And then if you have any actionable advice or, books that you recommend.
Why don't you start, Andrew?
Yeah, sure. I mean, I wouldn't say it's a warning sign, but when rates were, getting to like 3%, for 5 or 10-year fixed rate, that's when we were like, we got to lock in as many of these as we can, because I don't know how long they're going to last. And obviously it was a very competitive market, and we were always trying to stay disciplined. We're not going to go, buy something that's just, doesn't make sense. I think when it comes to opportunities, I think obviously we're bullish on industrial. I like the housing sector too, whether it's multifamily or single family. I just think when I look at like long term, they're just like that supply demand imbalance in the next 5 to 10 years. I'm not trying to look at things, a year or two, but more 5 to 10 year time frame. and you're just not going to build enough to meet the demand out there for either housing or industrial manufacturing. That's why I like these sectors. As for books, similar to Rob, I try to get away from real estate, my personal time. And recently I read a book called The Life We're Looking For. It's actually more about just getting away from technology and phones and whatnot. And that's a good reminder because, we're can get really sucked into, work and then technology. And it really, I think for all of us here, we need time to step back and breathe and contemplate, and so yeah.
Totally agree with that. Good actionable insights, I guess, 5 to 10 year horizon, not so short, visioned, because a lot can change. So if you're planning farther in advance, then you're going to be able to ride those waves out and it be a little bit more steady. So that I think is good advice. What about you, Neil?
I might add to Andrew, and definitely biased a little bit on the industrial side, just because we spend most of our time here. But one interesting piece that makes me bullish about it is we're kind of uniquely non-correlated with global geopolitical uncertainty. So the more kind of like craziness in the world that happens, the more it causes doubt and uncertainty on like all these complex systems in the world working. A lot of that actually is a demand driver for a lot of overseas manufacturing being brought to the US. And that I think we're going to continue to see people question, hey, does it make sense to, build our product 7, 10, 12,000 miles away from the US? And I think, the more, wars that happen, the more, kind of China continues to, assert its at least, local dominance in the Asian sphere there. I think you're going to continue seeing folks decide, hey, even if we pay a little more, it makes more sense to do manufacturing at home. And I mean, it's a continual driver for, a finite supply of industrial manufacturing. So that's one thing that keeps me pretty bullish about it. And then for reading, I'm like Andrew, I at the end of the day, I don't want to read about real estate. I've been in it, all day. But I have a friend named Carlos who's actually a really successful art trader, and I find his stories interesting and fascinating. And he recently recommended a book that quite literally arrived yesterday. It's set on my table. I don't know if you can see it with my filter. It's called the $12 million Stuffed Shark. Anyway, it's all about trading contemporary art. He swears by it. I have not opened it yet, in full disclosure, but I plan to tackle this next. So it could be an interesting piece on the world of art trading. So
I've actually heard a little bit about that. There was a question submitted. Do you guys do data storage centers or life science companies for their space?
Andrew?
We've looked at some. Currently, we haven't yet. I think there are a lot of institutions that are really chasing that, that sector, so they can get pretty competitive. And so I think those are great. Obviously, data centers with what's going on in AI is going to be continue a demand for that. So we're definitely looking, but we haven't pulled the trigger on one.
Good to know. Francis, I saved you for last, just because you have a very broad horizon, and I wanted to hear what you think are the best opportunities going into 2025, and if you have any actionable advice, and what book would you recommend?
I'm with Chris on thinking that markets are getting pretty frothy. So however you hedge that risk to anybody who's in the, in the public markets, whether you go, have a higher allocation of cash, or whether or not you get into shorting stocks or things like that. I think the rest of 2024 is going to be volatile around the election and stuff like that. But I actually think, and again, it depends on who gets in, but I think there's going to be volatility in 2025 as well. So long volatility, maybe shorting the market, not sure. Options have gotten a little bit complicated to trade because a lot of the volume is the 0 days to expiration. And also, markets are pretty much algorithmically traded now. I mean, like 60 or 70% of the volume is computers trading. So there's that. That all being said, I agree with the comments that Neil and Andrew have made about the reshoring. And I think that that is going to continue to be a trend against globalism, because I think that there is uncertainty, and I think there's volatility in the global picture for sure. And that, it's happening a lot in the currency markets as well. So books, I'm a super geek. I seek really fluffy, like, movies. Like, I don't have to think when I watch them. My life is crazy enough that I seek things that are very boring and very predictable for entertainment. But books that I've read recently, I read Steve Schwartzman's Whatever It Takes. It's definitely an industry book, but it's good. The book that I liked better, that I started reading simultaneous to that, was his partner that started Blackstone, which was Pete Peterson, who's passed away. Pete Peterson had a phenomenal story. He's 20 years older than Steve Schwartzman, who I think is now almost 80. But he was in the Nixon administration. He chaired the Council on Foreign Relations. So he had a very long career that was very, unique before Blackstone. And I just found, his stories about the world kind of fascinating, and now moving into more of the public sector myself, in some ways, I found that transition from private to public sector for him very fascinating. So
I'm a lot like you guys. I don't like reading about real estate when I don't have to. And I guess economy stuff and all of that, because it's always coming at you. But I do want to recommend the book Now Be Happier. It's a way to measure your happiness. And there's actually a scoring table. It's actually written by someone who is close with us. His name is Mark Halpern. So you can find it on Amazon if you're interested. It's got some good humor in it. After speaking with Mark about it, I think it's actually something a lot of people could benefit from, and just kind of figure out where they are on a happiness scale. Because a lot of people are asking themselves, what is their purpose? Where are they going? What's happening? And we let a lot of the outside world dictate that with our money and, the news and things that we can't really control. But what we can control is important. So thank you everyone for attending. I know this went on very long, so that's why I wanted to block off 2 hours. And it looks like we've kept a lot of people entertained to be on this long. So thanks everybody for attending. And I look forward to following up with all of you pretty soon, and hosting lunch and learns and talking more in depth about the things that you guys know best. So everyone have a great weekend, and I'll talk to you all soon.
Bye, everyone.
Thanks.
Thanks,
Bye.
Deanna. Thanks, everybody.
Thanks, Deanna.